All right, welcome everyone. I'm just going to give our audience a couple of seconds to start joining the call before we get started today. And I see that the audience is rolling in. So in order to get as much time as possible to our panelists, I'm going to get started. So welcome everyone. Today we are talking about staying prepared in a changing mortgage market. And this webinar is brought to you by Mortgage Capital Trading. A few housekeeping items before we get started. We'll be having a Q&A session towards the end of the webinar. You can submit questions at any time by using the Q&A icon at the bottom of your screen or by dropping those questions in the chat. HousingWire will be sending the webinar recording to all registrants in the next 24 hours, as well as the deck that's being used in today's presentation. The webinar will also be available on demand in our Knowledge Center. So with that, today's webinar, our panelists are Mike Fratantoni, who is the Chief Economist and Senior Vice President of Research and Industry Tech at MBA. And our other panelist and our point person for today is Phil Rasori, who is the COO at Mortgage Capital Trading. With that, Phil, I'm going to leave our audience in your very capable hands.
Awesome. Well, thank you, Allison. Appreciate everybody joining the call, and really appreciate Mike Fratantoni spending some time with us to give us his outlook on the on what we've got in store here for 2022, which has obviously started off to the races from a capital markets perspective. And you know, I think, you know, look, whenever I have Mike on, I just want to always make him blush a little bit that, you know, in capital markets, we're all thankful that we've got Mike, you know, at our side, you know, advocating for us in the mortgage industry. And again, I know I've reminded people on multiple webinars of ours of kind of Mike's heroic efforts during the pandemic to stop the stop the bleeding that was occurring in March, late March of 2020, when the Fed was damn near putting everybody out of business. So so with that, we'll get started. Just gonna that we've already done the introductions here. So just on the agenda, so we'll talk a little bit about mortgage, you know, the market cycles in the mortgage industry. You know, it might be obvious to everyone on the call where we've started off here in the first couple of weeks of January, as we've seen the you know, kind of the rate surveys basically rise almost 50 basis points in rate since last month. However, there's a couple interesting aspects of this cycle that might have some effect on volumes. So before we get into that, we're going to have a couple questions actually for the audience where you guys can participate. And then as you would expect, Mike's going to give us the you know, kind of the industry standard outlook, his outlook for 2022 in the mortgage market. I will say, looking at his or MBA's, I should say, volume numbers, those look a lot more realistic than some of the other, you know, I won't name names, but some of the other numbers that I've seen out there. Now, some will get updated, some get updated monthly. But there's no question that given the current rate environment, I think, you know, somewhere in the $2.5 trillion market seems a lot more reasonable. And I know that's where, you know, that's where MBA has us. And I think specific to that, and we'll talk more about this. This is interesting. You know, it's funny, ever since quantitative easing, these things seem to go in 4-year cycles, at least where we're sitting right now in 2022. If we look at 2013, or you know, taper tantrum that created the slow year of 2014 for us, you know, and then of course we had the, you know, Powell initially raising rates in 2018, creating a, you know, a slow year in the mortgage industry, and then we fast forward 4 years here, and you know, not that everything's cooked already, but we've got definitely off to a rising rate environment here in 2022. So we'll go through that, and then we'll go through some client metrics along with along with the forecasts that MCT's seen, and then we've got some on the MCT trade desk side, some actionable recommendations for the clients on the line. This MCT clients, this will be a review, as a lot of these are, because we have done a client exclusive webinar specifically on some of these changes, like the market volatility and also the FHFA announcement. That, of course, was last week. But we've got some new info in here as well for you guys. So with that, I'll move to the first question here that we've got. And, it's basically just what percentage drop in volume do you expect in 2022? And I see that actually the poll question here differs a little bit, but basically our kind of what we're trying to ask here is what you expect in 2022. And I'd like to, as we answer this here, just take a step back. We all of us in capital markets know that the minute you think rates are going to rise, especially basically since let's call it since late November 2008, when the world changed from a quantitative easing standpoint. Everybody think it's clear that you can never be certain. With that said, I wanted to, this is a good spot to bring Mike in, because I think that at least in my mind, there's been a little bit of a shift in, obviously, the obvious shifts of Fed, what the Fed is predicting, or what's being predicted in the market as Fed rate hikes, but also just as, what's occurred over the last couple of years with the pandemic. It seems like there's been a shift, if we look at when the initial, information on Omicron came out. There was a brief little rally, and obviously there's all the different aspects of variance, but it does seem that the market seems to care more about the inflation aspects than the economic aspects. And so maybe, Mike, I was wondering if maybe you could expand on that and kind of your take on where you see, if in fact, since so many have come before, if in fact we get another wave of the virus, what you think that does to rates.
Hey, Phil, great question. And thanks to you and the team in HousingWire for letting me be part of this discussion today. So, to your question, I'm going to side with Chair Powell here. He made a comment a couple of months ago, basically saying that with each successive wave of the virus, it seems like the economic impact has been a little bit smaller with each one, even though certainly the public health impact is still severe and very unfortunate. It seems like from an economic and market point of view, we're finding our way around this pandemic and figuring out ways to keep the train running, even if we have to work from home for a while or wearing masks or whatever it is. So I expect if we were to get another wave after this, the economic market impact is going to be diminished. Then to your point, we're in a different place right now, right? We're at 3.9% unemployment and 7% inflation. If we were to slow down a bit, that's not all bad news from an inflation story picture, right? But if it's an impact that really sort of tightens the screws on the supply chain constraints a few more notches, that may actually be bad news for inflation. So, who knows? The announcement may immediately lead to a drop in rates, but I'm not sure it's going to be the sustained drop in rates that we had with Delta or some of the earlier waves.
No, that totally makes sense, and I think that that's obviously, again, like we only have, we could have put an option in here for, do you expect a rate volume to pick up in 2022, and I think again Mike and I would both agree you don't have to look any further than the Ukrainian border to realize that there could be external factors that provide short-term drops in rates. But with all of that said, I think that the main Mike's comments are super valuable on the pandemic, because obviously that's been the main driver of this drop in rates that we've seen. And so as you guys can all see on your screen here, it looks like we've got a pretty pretty good, nice little bell curve there. And the majority think somewhere between 10 and 25% volume drop. And that actually leads into our next question here, because, and before I get there, there is an interesting dynamic that's fairly obvious to probably to everyone on the call, which is this dramatic rise in home values that we've seen over the past basically since the pandemic. I just looked at just quoting American Enterprise Institute, they had shown that the HPI is over FHFA HPI is up over 27% from the beginning of the pandemic. And if you think about that, I don't think any of us, Mike and I definitely weren't thinking that we'd be here 2 years later, on our early morning calls, that mortgage price, real estate values would be up 27%. But I think that speaks to this question, and we've got some interesting stats on this. The refi mix, if we look at where we are right now, looking at the Freddie rate survey coming out today, we're at 3.56. Just doing some stats on that. So for 2021, that survey averaged 2.96. November, which we've got some graphs on that, November we were at 3.07. So we're basically 50 basis points in rate higher, in 60 days. The interesting thing there is if you look at 3.56 today versus where we were January pre-pandemic, January 2020, we were at 3.62. So it's and I don't think anyone in January of 2020 would have thought that we were at historically high rates. So it's good to keep the latest market deterioration in perspective. But I think it is interesting because we've got a big, we've got a much higher, when we were looking at some of our client stats, we actually had a higher refi mix than we were expecting, given the fact that, we've drifted up in rates really throughout the year. If we go back to the absolute low point in 2020, again, using the Freddie rate survey, we were at 268, and then we drift higher and higher, and we'll show these graphs in a second. But it is interesting that we've held at about 45% of the pipeline being refis. Initially, that's concerning, but as we'll see in a second, that's a big piece of that is the continued presence of cash outs because of obviously the property value increases that have occurred. So that actually fits real well with what we're seeing here in our stats, that 60% are picking somewhere in the 50 to 75% range of purchase. So we will move. So before we get into some of the, some of our graphs here, I just wanted to talk about, a little bit something that our marketing team's working on basically some white papers on just rate cycles. It's obvious, pretty obvious where we're sitting right now, which of course is our bottom. This would be the bottom right the mortgage world in general, as most would expect, would sit in top top left, which or bottom right. So top left would be your basically what happened in 2020. Bottom right, hopefully, again, kind of what we started to see in the beginning of 2022. But I do think that with regards to pieces of the market, and let's talk about purchases specifically, and the fact that, and Mike can talk about this as well, but the fact that we've seen, while we see obviously in rising rate environment like we have now, we've obviously also seen this property value increase, home price appreciation. And when you have, when you have that, you have this, that coincide with larger loan amounts, obviously, and from the FHFA conforming loan limit increases of almost $100,000, we can see that that's going to be that definitely helps out from a volume standpoint, not a unit count standpoint. And I think Mike, you had some interesting comments on when you look at units of purchases, the increase in volume isn't very impressive, right? Versus, is that right? But volume is a little different story.
Yeah, when we looked at 2021 from our weekly application survey, and you track sort of year on year, first half of the year, 2021 was running ahead of 2020. Obviously, you had the big dip in 2020 in that March-April timeframe. Second half of the year, though, remember, we came out of the gate strong in the second half of the year for 2020. And so units were actually higher than in 2021. But because of that double-digit home price growth you're talking about, on a dollar volume basis, at least by our data, 2021 was strong the whole year round. We'll have to see what comes the year ahead, but at least our expectation is to see both units go up and home prices still to go up, but not the crazy pace they've been up over the past year.
Yeah, that makes sense. So, and then falling rates, falling volume. I'll just talk about that for a split second here. That's really a very luckily a uncommon phenomenon, and really that's a disconnect. That's your late 2007, early 2008 countrywide warehouse line had been pulled. We got rates finally coming off of the October highs of 2007, but volume wasn't exactly killing it because there were a lot of products that existed 6 months prior, had completely evaporated. The same situation, of course, in early March of 2020 or mid March of 2020. Same situation occurred because of the scare that was happening in the markets from a lot of different perspectives. So that doesn't happen very often. Vast majority of the time, obviously, we sit in the upper left to the bottom right here. So the last question, and then we'll get into the meat of the kind of the outlook. We'll hear from Mike and talk about some actions that you can take here. Is really the biggest concern for this year is are we looking at maintaining market share, managing margins, doing reduction in force, or potentially retention versus acquisition of originators, regulatory policy, Fed policy, and unease in the housing market. The bullet points 4 and 5, I know Mike has a lot of comments on those. But actually, Mike, this might be a good time for you to maybe you to, because we'll go through your stats on where you see the market and where you see mortgage, but maybe just you can go over kind of what your larger fears might be or just concern as far as volatility in the overall market as it relates to regulatory policy or Fed policy.
Yeah, it was interesting. We were talking before about what could be the impact of another pandemic wave. And I've had this experience too, Phil. Well, I'll give a whole outlook talk for an hour, and somebody will say, you didn't mention COVID once, right? So it's kind of moved off the screen, at least when it comes to economics and our forecast. And so, you didn't include it on your list here, and I didn't see anybody in the comments saying, what about COVID? So I think, to my mind, most of the potential for volatility is coming from the policy side, either from the Fed, announcements they might make about path of short rates, announcements about the balance sheet, regulatory policy. You mentioned the FHFA announcement with respect to LLPA changes. Don't think they're done yet. We could have, FHA mortgage insurance premium changes. That could have a big impact on the market. Congress seems pretty tied up at this point, so I don't think we have to worry too much about tax changes, at least not this year. But still, lots of opportunity for policy to lead to volatility. But really interesting seeing these survey results. Narrow win for unease in the housing market, but managing margin second.
Yeah, that is interesting. And definitely market share, Fed policy having some response. That definitely is interesting. I think the and makes a lot of sense. I think the regulatory policy we'll definitely talk about with FHFA, and love to get Mike's thoughts on where we might head into the future, because we definitely agree that the latest announcement seems in line with what the current regime would kind of continue. You could extrapolate from that announcement. So that's great. So now, and I'm sorry, we got one more question here. What are you most excited about in 2022? Basically, are you excited about live conferences? The fact that continuing profitability. Third bullet point here is interesting. We should talk about that for a second. I think with the prior FHFA regime, we were very, and I will not ask Mike to chime in here because for obvious reasons, he has to be more diplomatic. But we were very clear, a lot of us in capital markets, that you can have your ideas on where the agencies should be, where they should be in the market, how quickly they should be removed from their current positions in the market, as far as going back to privatization, but more importantly, how dominant they should be. You can have that argument, and I think we can all agree that in 1938, when Fannie was created, they probably weren't thinking that you could have one owner-occupied house and 9 rental properties, or a $970,000 second home, alone. That probably wasn't in. So I don't think any of us argue that what the prior FHFA regime, might have had some merits to what they were doing. However, the key factor that really disrupted, and if you look at it going back from April 2020, every disruption was from basically regulatory, was from that FHFA, those FHFA changes, and it wasn't the actual change, it was the lack of lead time that was given in the change. So I think that's that's really what we mean by that third bullet point. So look here, the new opportunities in the origination space, I think that's interesting. Mike, we have a lot of questions on, rates rise, and every time rates rise, we think arms are going to come back into, and arms or non-QM, you kind of take your pick. It almost seems that every time arms and non-QM get a lot of focus, it's really good news for the mortgage market, because that means that there's going to be a rally coming, and everybody's going to go back to fixed rate agency again. But absent that, talk about new opportunities for a second, and kind of how that might. I mean, how do you see the yield curve? Most of us on the call know that we have arms are a function of that short rate versus the long rate. I haven't asked you about this, but maybe you could talk to how you think about that, and how you think of arms in the short term and maybe the medium term.
Yeah. So I think most folks know I started my career at Fannie, and then went to MBA in 2005. At that point in 2005, the arm share of the market got to an all-time high of 35%. Today, we're below 4%. We've been as low as 2% some weeks in our weekly application survey. So I think directionally, absolutely, over the next couple of years, that arm share is likely to go up. But, will it get to 7%? Or, we're not hitting 35% ever again, because you don't get the same juice for the squeeze that you used to, right? Because we're not moving to 6 months deeply teased arms. The arm product is a 5/1 or a 7/1 or a 10/1, and small benefit for the borrower in terms of payment, but it's really not enough to move the dial, I don't think, for most borrowers. Non-QM is interesting. I think you got a lot of players out there that are sort of poking around. You have some that are sort of specialists. Investors are sort of more than willing to take some additional risk at this point in the cycle. And it seems like most of the non-QM getting done is just a little bit over the edge, right? This is not old school subprime. This is just a self-employed borrower that's got a difficult time showing what their sustainable income is, right? But still might have strong credit. So I definitely see non-QM growing, but it's going to be a small part of the market. I don't see it moving up multiple times. It's going to move up, double-digit percentage.
And just actually leading into that, I'll skip to the third bullet point here on the FHFA fee increase announcement. And, I think there's been enough press on that. We won't go deeply into it, but basically, that increase, fee increase, if we look at where that hit, it's your high balance, and then of course your second home borrower, which would be your wealthier borrower. And that would probably make sense, I think, for all of us, on where we would think that the new FHFA direction might come in of putting fees in for certain products that targeting the higher end borrower, or I should say higher net worth borrower, more wealthy borrower, to help pay for some of those higher LTV products, the first-time home buyer products, maybe higher DTI products. I think the interesting thing, kind of tailing into your comments, Mike, about non-QM here, would be maybe the PLS space, the private label security space, and with the disconnects of last summer, of where there was these harsh all-in thresholds of 7% and of non-owner and second home loans. There was a frantic kind of search for these facilities, and issues with the document custodians and everything, to get these private label security facilities set up. But then they got set up, and what was interesting is that creates an issue for the agencies, in that you have this artificial adjustment at the lower end of the LTV spectrum, where that adjustment of 2 1/8 continues down below 60% LTV, and that obviously is meant to subsidize other products. But I think we all of us in capital markets thought that long term would be an issue. Now that private money has come into the space, it's interesting to see this now with second homes. And although second homes have a little bit more of an issue with private securitization, you just given the sheer size of those price hits that literally at the higher LTV literally rise more than a 1% rate. Do you see more private money coming into that space in the next year?
I do, and from multiple different directions, right? We talked to some of our bank members, and their initial reaction was, look, we are still flush with deposits. We could put all of these second home loans on balance sheet. If it's 4% of production, the portfolio is looking for good yielding assets, and we get to price it up a little bit, and still it's a better deal than the LLPAs would suggest from a GSE execution. But yeah, I expect that for a lot of the IMBs out there, it's going to find a PLS home. And you look at some of the Wall Street forecasts of total PLS volume going from 80 billion last year to 100 billion this year. That sounds reasonable to me, thinking about the increment of volume that could move over. And to your point, not in a panic the way volume had to move over last year, but with enough lead time so it can be a sensible decision of whether you keep sending to the GSEs and pay the LLPA, or whether you make the investment to build some rails to an alternative execution.
That makes sense. So we're just going to jump in with a couple graphs here, and then I want to make sure I know, as expected, because there's plenty of stuff to talk about. As expected, I'm a little bit behind here. I want to give plenty of time for Mike to go over his forecast on the economic side and on the mortgage side, because I know a lot of you online are interested in heavily interested in that. I just want to go through, just really we've got a little bit of a deja vu here in it just kind of level setting everyone in what happened in 2021, beginning of 2021 versus the beginning of this year. So we had, if you guys can remember, and you can see that you got the UM32. So a lot of you guys think of it as the Fannie 32 coupon at 104. Okay, that's a ridiculously low rate. So we were at, I think we were at 268 on the Freddie rate survey in December 2020. That's what we averaged. So that's basically your low point in mortgage rates. Period. So you can see that for the first week and a half, we had a pretty good drop, almost a point and a half drop in that coupon, and there was concern that definitely moved. There was some one and a half coupons traded in December, a lot actually. And that definitely got rid of the 1.5 and basically made the market coupon into the 2 to 2.5 range. The reason I say that is it puts it in perspective a little bit of what's gone on. The first 3 weeks of this year. When you look at the slide to the right, we've had a little bit more of a drop, and to be clear, it's the 2.5 versus the 2. So you can call it, we're about, and that would make sense. We're about 75 basis points higher to 80 basis points higher in rate right now. But no question that the beginning of last year, we had the same situation to a certain extent happen. And so I think that's good to keep in perspective. And then I know these are small here. We'd put these graphs right in at the end. I just wanted to go through real quick. There is a lot of concern out there that hey, gosh, there's more refis than I thought. But just to be clear, like we had talked about earlier, the left graph might look a little concerning that 45% of the production is still refi, but when you look at the overall cash out versus rate term picture, you're still sitting at only 20% rate terms, 25% of the pipeline cash outs, and 20% rate terms. Mike might have better stats on this, but I mean, there's always going to be that borrower that's had limited access to the internet or a TV, and might have a vintage mortgage that's pre-pandemic, and just again, we go back to pre-pandemic January 2020, we were at 362 on the Freddie rate survey, and we're 6 basis points lower than that now. So good to put that into perspective. So with that, I'd like to go to Mike, if you can take it over and kind of just give us your thoughts on 2022.
Sure. So this is the December version of our forecast. Look for a January version over the next week or so. Not going to look very different from this. I'll highlight to the extent there are any changes. But first, the macroeconomic perspective. You can look at the quarterly forecast, but I think if you just focus on the right side of the page on the annual numbers, 2021 really an outstanding year in terms of economic recovery. And yet, as you heard, every time you turn on the news, supply chain constraints really keeping it from being as strong as it could have been. And so the impact of that is some of the growth that would have more naturally happened in 21, absent those constraints, spills over into 22. So, we're forecasting 4% growth in 22. Think about trend growth in the US economy at about 1.7 or 1.8. So 4 is spectacular. 5.5 was even better, but 4 is still very, very strong growth. And the upside of that is we are going to see continued improvement in the job market. We were at a 3.9% unemployment rate in December. We're forecasting we're going to be at 3.5 by the end of 2022. Honestly, it could go lower than that. And if you remember, February of 2020, we were at 3.5, which was the lowest the unemployment rate had been in about 70 years. So there are still almost 11 million job openings in the economy. You hear about 4.5 million people leaving in a month to look for better opportunities elsewhere. Wage growth increasing. There still are a lot of people sort of on the sidelines, not looking anymore, or not looking right now. That labor force participation rate isn't moving. So we've not enticed them to come back in the job market yet. That it might happen in the months ahead, but we think it's going to be slow going there. So the unemployment rate will keep dropping. Now, the downside of this faster growth is much higher inflation. So we were at 7% headline inflation, 5.5% core in December. You see our forecast here, that consumer price number. We think it'll be decelerating down to 3% year over year by Q4 of 22, but that's still substantially above the Fed's 2% target. So if you're a central banker and you see not only is inflation very high today, but it's not transitory, it's likely to persist for any number of reasons, stay higher than their target, they got to get more aggressive. So you see our forecast in line with the latest FOMC prognostications of 3 hikes in 22, another 3 in 23. The big unknown out there right now is if you listen to Fed communications, they're saying that this rate cycle will top at a Fed funds rate of about 2.5. So, we don't see right now that us getting there until really the end of 24. If this inflation stays this high or higher, and the unemployment rate moves as low as I'm suggesting or lower, they might have to move that up in terms of timing. If that's not enough, sort of the next turn of the dial is to say, okay, 2.5 may not be enough to get this inflation number back in line. Maybe we have to go to 3 or something higher. You haven't heard any current Fed officials say that yet, but you did hear a retired Fed official, Bill Dudley, talk about that in a Bloomberg column. listen for that. That's an important signal if they are beginning to think they have to go higher than the 2.5% neutral. Another piece of information to listen for from the Fed is with respect to the balance sheet. You heard about the acceleration of the taper. They're going to stop adding to their balance sheet by March of this year. You've begun to hear several Fed officials ruminate about, okay, we're going to have a $9 trillion balance sheet, $2.5 trillion in MBS. How do we get back to the $4 trillion balance sheet or a $5 trillion balance sheet that we had pre-pandemic? Most of the thought right now is just passive runoff the way they did previously. That could start as soon as June. Listen at the January FOMC meeting for any info about that, and listen for an announcement about that probably in March. Now, again, another turn of the dial, if you've heard some Fed officials say they're worried about the sort of strength of the housing market, they could, rather than redirecting MBS prepayments back into MBS, redirect those into treasuries. There is a view in the Federal Reserve System that their balance sheet should be all treasuries. So they're not directing credit to the housing market. Powell doesn't sound like that's where his head is, but again, you could hear some other Fed officials particularly talking about that. I don't think they're going to go there, but it could happen. And to my point earlier that the Fed can be a source of volatility this year, particularly around these balance sheet announcements. Listen for that. So Phil, if we can go ahead one more. Go ahead.
Mike, I was just gonna, I would love to just expand for a second, because that's the first time I've heard that. I mean, that's great info. Potentially redirecting basically the mortgage payoffs into treasuries. Not to spike the football, we have always said that hedging mortgages with treasuries is introducing basis risk. Mike, I think you would agree that if they were to do that, you've got your hedge position basically dropping in rate, so rallying, and you've got your mortgage tanking your asset, all things being equal. So that's what we call a bad hedge.
Exactly. That's not a good day at the office for you guys, I know.
Yeah.
All right, let's move ahead to my next page, which is focusing in on what people actually pay us for, which is our mortgage origination volume forecast. So apologies that this might be hard to read, but this is available from me on our website, and you'll get this deck. Top half of the page is looking at the housing market. So we're anticipating growth in construction. There are 770,000 single family homes under construction right now. We need that desperately to address the inventory issue. You just saw the realtor number this morning. Existing home sales in 2021 up 8% from 2020, highest level since 2006. We think we're going to grow further in 22 and 23. You look at our home price forecast, I would describe this as optimistic, where full year 21 home prices grew at 16%. We think full year 22 that'll decelerate to 5%. So still growing, but not nearly as fast as we get some additional units on the market. If you place this relative to some of the other forecasts out there, I would put a low point. CoreLogic has a forecast of 2% by the end of 2022. Some of the Wall Street folks have as high as 12%. Our 5%, again, I describe it as optimistic and low conviction. This is dependent upon builder supply chain constraints, getting much, much looser than they are now. I think ours is a reasonable forecast, but a lot of uncertainty there, and that all plays into the forecast numbers. So the one that we've gotten a lot of attention for, we think the 30-year mortgage rate, which was at 3.6 in our survey last week, get to 4 by the end of the year, level out at about 4.5 as we get into 23 and 24, and then volume. 20 and 21 were $4 trillion years. As Phil mentioned, our forecast for 22 and going out to 24 is in the neighborhood of 2.5. To get there, to the first poll question, we're projecting about a third drop in total volume, a 60% drop in refi, and a high single-digit growth on the purchase side. So moving in opposite directions, but that comes from rates moving higher, taking out that incentive, a lot of burnout, as Phil was mentioned, with those older loans. On the purchase side, you got demographics, which are still very positive for purchase demand. You have Home sales likely to increase, home prices going up. That's a recipe for increase in purchase volume. Our refi share estimate was at 57% for 21. We see it drop into about a third of the market in 22, with most of that being cash out. So Phil, interesting to see in your numbers that those shares have not budged much yet. My expectation is that rate term will go down, that cash out will stay flat or even go up a bit. So let me stop there.
No, that's great. And when Mike talks about 4.5 in 2023, I think it's as I was looking at kind of just the historical rates this morning, let's just read the surveys averaged basically 4.5 in 2018. So not that 2018 was the stellar year of the mortgage industry, but it wasn't catastrophic either. So I think that's that's important to remember. So that was great. That was awesome. So thank you, Mike. And we got basically I know we've just got a couple minutes here to I drifted over time as probably expected. So we're going to hop over. This is just some metrics that we've seen on the new lock volume. I'm actually going to skip over that. Just to summarize that new locks, are down in the last 2 months about 25%. But that's really right in line with where with where Mike's volume numbers are, and as he had said, you take up basically a third out of the out of the market there. So just getting back into the trade desk recommendations. Again, this is review on the for the MCT clients, but basically just the top bullet point here: trading with higher frequency. Obviously, we've had a lot more reprices during the day. We've had market movement, intraday market movement. You are trying to set your hedge at the same point at which your loans are being locked, the same value at which your loans are being locked, and so. One of the issues that happened, if we go back again to taper tantrum days of 2013, when we go out and we tell everybody, hey, trade with higher frequency, the drawback of that was that now, especially if you're smaller lender, you can't do AOTs down the road, because you have, number one, a lot of investors had $1 million minimum on AOTs. So if you split your TBA hedge positions into $500,000 increments, that was problematic from an AOT standpoint. And then also they had thresholds. So you had 2% up or down thresholds. Now, with the new AOT programs out there, the hybrid AOT or bid tape AOT, you are allowed to combine your trades. And so that is a game changer. So now it really takes out any reason that you wouldn't, it takes out any reason that you would not trade with higher frequency and split your trades and make smaller trade positions. So obviously there's some liquidity issues if you get down below 500,000, but from a standpoint of matching that second bullet point, matching the market levels, the hedge positions, the front end locks, you're going to want to you're going to want to trade more frequently in smaller amounts. And then with AOTs, I want to talk about that for a second. We say paradoxically here, the AOTs can provide cash flow benefits during market deteriorations. So what's funny about this is this is obvious. AOTs are huge from a margin standpoint, especially now. A lot of the AOT programs will accept that trade immediately. So the mark-to-market margin exposure immediately comes off your line, which is huge, right? From in a big rally, dare I say, March of 2020, you can get rid of some of that exposure that could be catastrophic or existential from a cash standpoint. With that all said, though, in the normal selling of loans, if you think about just how your how your purchase, selling a loan today, if it's going to get purchased in, let's say it gets purchased in a week. If you've got a February security, doing an AOT will fast forward that cash experience that you would normally, get on the settlement date, pairing that trade out. Doing an AOT will fast forward that cash experience and get that benefit into the price of your loan, which will occur 2 to 3 weeks earlier. So, and I know Allison's popped up here because I'm right at 50, but look, intraday market sell-offs, just keep in mind that from the servicing valuation perspective, this will change. The servicing buyers are becoming more and more sophisticated. They are very sophisticated already. I shouldn't say that, but they're becoming even more sophisticated, even more technologically able to adjust par rates very quickly. With that said, a lot of buyers do not adjust par rates intraday. So what that means is if you have a Fed announcement and you have a big market tank in the middle of the day, you are better off waiting until the next day to get that positive service and value improvement, all things being equal. That only works if you're fully hedged on your production. And then the last thing is, it's probably understood now, but just your mindset needs to change on the pipeline management side. Loans are, from a secondary standpoint, loans aren't as cool right now, right? We don't want to do everything we can to close loans for free like we do in rallies. So and obviously on those affected products with the FHFA fee increases, we want to be careful of any lock extensions, like with second homes or high balances. So Allison, if maybe we can get into the questions.
Let's jump into the questions. Now, for our audience, I know that there are a lot of questions and we are rapidly coming to the end of our webinar, so we'll do our best to get through as many as possible. And any that we don't get to, HousingWire will be passing over to MCT and they will be able to reach back out to you afterwards with some answers. So with that, I want to jump right into questions. First, Phil, Mike, thank you so much for taking us through this. I wish that we had more time to get a little bit more information and pick both of your brains a little bit more, but I told you these webinar hours go fast. So let's start with Phil. How do you see lock volume trending from here?
Well, I think, like we talked about, I think that when you look at the purchase versus refi mix right now, it looks nasty at first glance because I don't think any of us expect, especially given Mike's forecasts, any of us expect refis to be a big part of your pipeline. But the good news is that as Mike said, there's this expectation that cash outs will increase. So I think that our numbers of our estimates would be, the beauty of this is they're pretty in line with Mike's estimates that are really in line, frankly, with what we saw on the bell curve of our question there, which was 25 to 50%. And I think, Mike, I don't want to misquote that. You were kind of basically expecting from here to get to your 2.6 number, basically a 30% drop.
That's right.
Is that right?
Yeah.
And that would be really kind of what we would expect too, Allison.
Mike, I want to give you an opportunity to jump in before I toss you a question.
Yeah, I mean, I would just point to what we're seeing in the last couple of weeks from our weekly application survey. It's very much in line with what I think Phil is showing from his clients of refi going down, purchase going up. That's the expectation for the rest of the year, and in line with our forecast.
All right. So with that, do you both think that, are we still in store for a typical spring home buying season, or what could derail that?
I'm happy to start, Phil, if that's all right. So, as I talked about in my comments, you look at the demographics, the large cohort of millennials who are ready to buy. You look at first-time home buyer share of the market in the news this morning, 30%, up from 26% a couple of months ago. That is exactly where we need to be in terms of strong demand. Couple that with a very strong job market and rates. Yeah, they're a little bit higher, but they're not at the place where they're spooking buyers yet. So demand is there. Builders are putting up more inventory. That addresses one part of supply. We need people to move. We need current owners to move into those new homes and free up some existing supply. That is the last piece of the puzzle. Once that ball gets rolling downhill, it gets a lot easier, but we're still a little bit stuck right now. And so the risk is either we don't get enough new supply or we don't get existing owners willing to list their properties.
Yeah, and just tailing into that, those comments make a ton of sense. I think I sit out here in Northern California, which the other issues screaming at us, I think, would be just affordability. We definitely have incomes are higher, but and this is only with certain areas of the country. But you do see these home values, and you begin to wonder just how much more they can increase without a little bit of an affordability crisis here.
Absolutely. So with another sort of question that I think is an interesting segue after that one. So what type of product types, such as cash out refis, ARMs, or non-QMs, are we going to see have a comeback in this current environment?
Well, I'd love to, maybe get Mike to expand a little bit on, what you had talked about earlier, Mike, with non-QM and ARMs. But I think that, we definitely see again in the California region, this continued need for jumbo product. Obviously the high balance was helpful. I know there was talk in this regime. It was interesting, Mike, to see that definitely there was a nice pop to high, there was no change to the high balance rules as far as the increase in value. There was a hit to high balance, that came in on the FHFA increase. Maybe where do you see any risk in the future with this administration would probably be the best question to the high balance? I know there was talk about that in the past of would they continue the 150% rule into perpetuity?
Yeah. So the way we talk about it, and I think under Acting Director Thompson, hopefully to be confirmed Director Thompson, as you said, it's a really different approach to the market, and it's dials and not switches, right? So using pricing to nudge some of that high balance over into the private market rather than slamming the door. And so I think the way you talked about it is the same way that we're thinking about it, Phil, where they have a budget in mind in the sense of raising a little bit of revenue from second home and high bal, and then spending that on first-time home buyer products, right? And so they're raising the revenue first. We're waiting to see what they offer in terms of discounts on LLPAs on that first-time home buyer section of the grid. But that's the way we think they're going to do it. And they're going to do it gently with lead time, April, not tomorrow. So, really appreciative of that.
All right, I'm gonna throw out one last question before I think we will be out of time. Mike, you correctly predicted rates rising. What is your next prediction for us?
So as Phil said, this is a job which keeps one humble, right? Forecasting rates certainly at a high frequency is a dangerous game. My forecast is over the course of the next couple of years, certainly expect rates to go up. And we've been right this far for all the reasons that we talked about. I think the easier forecast is the one I talked about today, which is just given the trend that we've been on, pretty easy to suggest that we're going to move from a refi dominated market last year to a purchase dominated market this year. That comes with all the opportunities and challenges the industry is always faced with such a transition, likely a period of tighter margins, likely a period of addressing capacity. But, on the other side of that, these record purchase years means that there are going to be a couple of very strong origination years from a historical perspective going forward. It's just this adjustment from gangbuster 2020 and 21.
All right, Phil, I want to give you the opportunity to sort of round out with any finishing statements before I wrap us up here.
No, this was great. I really appreciate Allison, you and HousingWire giving us the opportunity for the webinar here, and Mike, most of all, thank you for giving us a rundown on the market, which I think there's a lot of. I think your ending comments were very well taken here. That there is a lot of fear out there, as we've had some pretty good times over the last couple of years, and but this it's good to put this pop in rates in perspective, and also remind that we've got a hell of a purchase market, regardless of what happens with supply and demand. Loan volumes in general, and that's at the end of the day in capital markets, that's what we all operate off of, are going to be doing pretty good. So.
All right, well, thank you both so much for joining us. I know I personally have a couple pages of notes and learned so much from all of the points that both of you raised, but unfortunately we are out of time for today's webinar. Again, thank you, Phil. Thank you, Mike. And thank you for our attendees for participating. I know there are questions we didn't get to. We will, like I said, be passing those over to MCT to get you guys some answers. And the recording of this, as well as the deck, will be available on HousingWire's website. With that, we are at an end of today's webinar, and I will see you all again soon.
All right.
Thank you.
Thank you.